Okay, so this is the video number 2 in this series of videos for the chapter number 8. In this video, we will be discussing about constructing the theoretical spot rate curve for the treasuries. But uh, the what we mean by the theoretical spot rate curve for the treasuries is that we have a default free spot rate curve is represented by treasury spot rate treasuries. But how does one obtain a default free spot rate curve? There are these can be constructed using these four different methods or four different ways. One of the ways is use treasury coupon strips. So we can use treasury coupon strips, and if we are using treasury coupon strips, we have the uh, it's the simplest way to construct the treasury yield curve using treasury coupon strips, because it would seem simplest to use the observed yield on a treasury coupon strips to convert an actual spot rate curve, because there are uh, uh, as we have seen in our previous lectures. But using treasury uh, strip curve has its own problems. The second method one can use is on the run treasury issues. On the run treasury securities, not stress but the securities. The third way is use on the run treasury issues and some selected off the run treasury issues, and we will discuss why we use this. Then the fourth is the all treasury coupon securities and bills. The when we do this, when we calculate treasury, our focus is selecting the universe of securities used to conduct a default free spot rate curve. And we want to make sure that the treasury yields are not biased by default rates, uh, embedded options, liquidity, or the pricing errors. And to deal with the default, as we have already seen that we are using treasury securities, issues with embedded options are avoided because market yield reflects the value of those options embedded. So there is no point in including there. Liquidity, basically it varies by the issue. So there are US treasury issues that have less liquidity than bonds with a similar maturity. In fact, there are some issues that have extremely high liquidity because they are used by dealers in repurchase agreements. Finally, some countries, the trading of certain government bond issues is limited, resulting in estimated price that may not reflect a true price, which we call a pricing error. So the treasury coupon strips, what are the problems is I have already said it's the simplest way, but it has its problems. The one of the problem is low liquidity. So the treasury strips are very less liquid. The other ways are strips, it means the observed rate on these strips also represents a liquidity premium. So the observed yields include some liquidity premium, so they cannot be used as simple yields. Second issue is the tax treatment, because the uh, treatment of strips is different from the treasury coupon securities, especially the accrued interest on strips is taxed, even though the no cash is received by the investor. Thus, they are negative cash flow securities, taxable entities, and as a result, their yield reflects this tax disadvantage. Finally, there are maturities across where non-US investors find it advantageous to trade off yield for tax advantage associated with a strip, especially if certain foreign entities use the return on these treasury strips is a capital gain is compared to a coupon strip. So this is what we mean. For the on-the-run issues, the most recently auctioned issues of a given maturity are used. The most recently auctioned issues is basically include 1 month, 3 month, 6 month treasury bills and 2-year, 5-year and 10-year treasury notes. The treasury bills are zero coupon instrument while the notes are coupon instrument. The observed yields for each of the on-the-run issues then used to calculate the spot price. For the coupon issues, these yields are not yields used in the analysis when the issue is not trading at par. Instead, so this is very important to understand here. For coupon issues, the yields which they are uh, trading at are not used. Instead, for each on-the-run coupon issue, the estimated yield necessary to make the issue trade at par is used, which is called the par coupon curve, right? So it's important to understand that do not use the observed the yields, but we use for on-the-run securities we use yields uh, that are estimated, which are necessary to make the issue traded par, right? Okay. The third is on the run treasury securities and selected off the run treasuries. One of the problem with using this is on the run issues is the large gap between maturities, particularly after 5 years. To mitigate, we use this some off the run securities as well. Typically, the issues used are the 20-year and 25-year issues given the par coupon curve. So it's very important for you to understand what we mean by a par coupon curve. Par coupon curve is, I am explaining it again, par coupon curve is the curve which plots the yield necessary to make the bond trade at par, right? When we plot it again, maturity against maturities, we call it par yield curve. Then we use the bootstrapping method. Uh, all treasury securities using only on-the-run issues and few off-the-run issues fails to recognize the information embodied in treasury prices that are not included in the analysis. That some market participants use all the outstanding treasuries. Common practice is to filter the treasury security universe to eliminate securities there are on special into the repo market. When all coupon securities and bills are used, the uh, methodologies are become complex, which is not the scope of our this course. So just understand that these are these in this just the all the universe of treasury securities is used. Then we have a concept of the swap curve, also called the LIBOR curve. So what first let's understand that what we mean by swap curve and why we are talking about this. So for example, in the United States, it's common to use the treasury spot rate curve for the purposes of valuation. However, in other countries like Pakistan, either a government spot rate curve, just like we have discussed, if the market is liquid for the securities that exist, or a swap curve is used. What is a swap curve? Uh, so swap curve is the curve. Let's before discussing the swap curve, let's discuss what we mean by a swap. So a swap is a transaction in which two parties exchange cash flows based on a notional amount, right? Two parties exchange cash flows based on a notional amount. So let's discuss with the help of some example. So let's suppose there is a party A and there is a party B. and let's say the notional amount is the notional principal which we are referring to is 100 million, right? So it's the 100 million, and we are saying that one party is paying a floating rate and receiving the fixed rate. So one party is paying the let's suppose one party is paying the fixed rate, which is party A is paying 6% and receiving the floating rate, while the party B will be paying the fixed rate and floating rate and receiving the fixed rate, right? The payments are, let's suppose, the quarterly. So the fixed rate is 6% is called the swap rate, or equivalently the swap fixed rate. The swap rate of 6% multiplied by the notional amount of 100 million gives the amount of the annual payment of 6 million. So they will be paying 6% to them. So the amount they will be paying will be 6 million each year, right? While the amount they will be receiving will be some benchmark rate, right? So let's suppose that it could be a 3-month treasury bill or a 3-month LIBOR rate. The most common reference is the LIBOR in Pakistan. It's the KIBOR. So there, this can be a 3-month LIBOR or the KIBOR rate. So let's assume that the consider the reference rate is 3-month LIBOR, and that the swap one party is paying fixed rate of 6% and receiving 3-month LIBOR for the next 7 years, and the 7-year swap rate here is 6%. But entering into this swap with a swap rate of 6% is equivalent to locking a 3-month LIBOR for 7 years. So costing this in terms of 3-month LIBOR, the 7-year maturity, 3-month LIBOR is so LIBOR can be anything. So LIBOR, let's assume here the LIBOR is 4.2%, right? So they will be then paying 4.2% of 100 million, which is minus 4.2 million, right? And they will be receiving plus 4.2, and they will be receiving plus 6, right? So this is a swap. So it's a notional principal is 100 million. One party is paying 6%, other party is paying 4.2%. Because they are paying 4.2%, they will pay minus 4.2 million negative here, positive here, 6 million negative here, positive here, and this 6% will be called the swap rate, right? Okay. The important thing to note here is I have already discussed that by entering into this swap with a swap rate of 6% is equivalent to locking 3-month LIBOR for 7 years for party A. So costing this in terms of 3-month LIBOR, the 7-year maturity rate of 3-month LIBOR is 6%. So suppose that the swap rate for the maturity is quoted in the swap market or are shown below. So let me show you a curve, which is a swap curve. So okay, so you can see that for a 7-year period, the swap rate is 6% locked through a swap agreement. these are the swap rate for different maturities. If we plot these rates against these maturities, this will be called a swap curve. But this swap curve is telling us that how much we can lock in a 3-month LIBOR for a specified future period. By locking in 3-month LIBOR, it is mean that a party that pays the floating rate, in our case, party B, is locking in a borrowing rate. The party receiving the floating rate is locking in an amount to be received. Because 3-month LIBOR is exchanged, the swap curve is also called the LIBOR curve, which I have written here, right? So this swap curve or the LIBOR curve. Note that we have not indicated the currency in which the payments are to be made for our hypothetical swap curve. Suppose that the payments are in US dollars, then the curve will be called the US swap curve. If the payments are in euro, it will be a euro swap curve, and if it is in rupees, it will be a Pakistani rupees swap curve. Finally, let's look at how the terms of swap are quoted. Rather than quote a swap rate for a given maturity, the convention is that the swap market is to quote a swap spread. The swap spread is basically the swap rate minus government yield on the bond with the same maturity as the swap. So the spread can be our benchmark desired, as I said, the government security. For example, consider our hypothetical 7-year swap. Suppose that the currency of the swap payment is US dollar, and estimated T-bill yield for the 7-year maturity is 5.4%. And if it's a 5.4%, then our swap spread will be 6% minus 5.4% equal to 1.6% or 6%, 0.6% or 60 basis points, right? So this is how we use it. Instead, if the it's a Pakistani, let's suppose it's a Pakistani government bond, Pakistani swap, and the yield on a Pakistani government bond is 5%, then we will get an answer of 1% or 100 basis points. Effectively, the swap spread reflects the risk of counterparty to the swap failing to satisfy the obligation. Consequently, it is primarily reflects credit risk, since the counterparty. So this is very important to understand again, that what we are showing here is that the swap spread reflects the risk of the counterparty because it's above the government bond yield, and it primarily reflects the credit risk. Since the counterparty in swaps are typically bank-related entries, the swap roughly indicate the credit risk of a banking sector or interbank or a double A rated curve, right? So that's what we are talking about. Why it is increasingly used? Why swap curve is increasingly used? As I have indicated, investors and issuers use the swap market for hedging and arbitrage purposes, and the swap curve is a benchmark for evaluating. So the swap market is used for hedging purposes and swap benchmark for evaluating fixed income securities, pricing for fixed income securities. Since the swap curve is effectively the LIBOR curve and investors borrowed based on LIBOR, the swap curve is more useful to funded investors than the government yield curve. So mostly investors are we deal with are the funded investors. The one of the disadvantage, however, of using swap curve is poor liquidity. What we mean by poor liquidity is that the uh, swap this swap curve include the liquidity premium. What are the advantages of using the swap curve? First is low regulations, make them comparable across different countries. Because there is almost no government regulations of the swap market, the lack of government regulation makes swap rate across different markets more comparable. In some countries, there are some sovereign issues that offer various tax benefit to investors, and as a result, for global investor, it make comparable analysis. The second is the since there is no underlying government bond, there can be no effect of market technical factors. What we mean by market uh, technical factors is that the supply of swap depends only on the number of counterparties that are seeking or willing to enter into the swap transactions, right? It does not uh, depend on the yield of the government bond. Third, the credit risk is reflected in the swap curve or similar, and make comparisons across countries more meaningful than government yield curve because different in sovereign risk. And finally, there are more maturity points available to construct swap curve than a government bond yield curve. So, for example, for the US government bond, we have only 3 months, 6 months, 9 months, 1 year, 2 year, 5 year, and 10 year. But for swap market, we have 2, 3, 4, 5, 6, 7, 8, 9, 10, 15, and 30-year maturities, right? So that's these are the main advantages of using a swap curve. Now let's talk about how to construct the swap curve. It is not the swap curve that is used for discounting, but the spot rates derives from the swap curve. So let's discuss how to construct LIBOR spot curve or the swap spot curve. The spot curve rates are derived from the swap curve in exactly the same way using the bootstrapping methodology called LIBOR spot rate curve. Moreover, a forward rate curve can also be derived from the spot rate curve, LIBOR, which will be called a LIBOR forward rate curve. Consequently, if we understand the mechanics of moving from the yield curve to the spot rate to the forward rate curve in the treasury market, there is no reason to repeat an explanation of the process here for the swap market. That is, it is the same methodology, just different yields are used. So the things we have done in the chapter number 6, it's the same things, just the benchmark yield used to drive those spot and forward rates are different. So this is all about this part 2 of the video. In part 3, we will be using expectations theories of the term structure of the interest rates.